why don't we get on into it? So today, in today's webinar, first and foremost, thank you so much for attending. We do appreciate your time, especially later in the evening on a Monday, on a day that a lot of people may have off. So we do appreciate it. What we are talking about today is all things cash value life insurance and talking about a very popular topic, which is company selection. What life insurance company or different companies should I select if I'm interested specifically in a whole life insurance product that is designed for maximum cash value? Because you don't need me or anyone for that matter to tell you that there are a lot of life insurance companies out there. However, when it comes to companies that have a track record of actually delivering strong cash values to policyholders, there are only a handful of companies that have actually disclosed proof of performance. A lot of times we see illustrations from different companies that sometimes look fantastic, but my question is always this, and this comes from corporations and banks asking this question before I was in a sales role and owned a company, which was, okay, where is the proof of performance, actual performance? So we're going to touch on that, or we're going to really get into detail on that today. So to start, when it comes to cash value life insurance policies, specifically a whole life insurance policy designed for maximum cash value, why people are interested in this is as follows. When we look at the core benefits, specifically focusing on the cash value, your cash value is a safe, liquid, and tax-free area to position your money. So to elaborate a little bit on that, safe, what do we see there? Net internal rate of return between 3 to 5%. What that means is that 3 to 5% net internal rate of return, that's the net growth rate, that will be consistent as the years pass, and that's consistent if things are going very, very well in the economy and stock market, or if things are going very, very poorly. Whole life insurance forever has really been referred to as a peace of mind product. I can view this as money I can bank on. No matter what happens, it'll just continue to appreciate. I've got that safety feature there. Liquidity. I can access my money anytime. I also have the unique loan feature, which grants me access to my money anytime. And if I borrow against that policy, my money continues to compound, all of it, any money still in cash value, and what I loaned against it as if I never touched it in the first place. Another way to put it is that there's no lost opportunity cost on your money. And then the third benefit, this is what attracts so many people, is if we do everything properly, I can access that cash value anytime I want, completely tax-free. Why I like to put this word if there is cash value life insurance, both whole life and indexed universal life, is always marketed as a tax-free area for your money. And it is, you can access your money tax-free. However, if I do not have the awareness of what can trigger a taxable event, that's where I can get into trouble. If I trigger a modified endowment contract, if I cash my policy out or it lapses when there's a gain, there are occasions where I can run into a taxable event with a life insurance policy. And we've got plenty of content on that. You can book a meeting with us and we can talk through that with you. But when we look at the cash value of a life insurance policy, those are the core benefits. Now, with that said, there's how many life insurance companies out there? 1,500 of them. Which one do I select? Well, that's what we're going to really get into today. So, company selection. I want the best company for my money. I remember earlier last year in the second quarter of 2021, I was speaking with an individual who pumps in about $400,000 per year into a whole life insurance policy. And his focus is the cash value. That's what he's interested in. He's got a lot of money just in cash that he's gradually moving over to a life insurance policy. But what was interesting, so 400 grand per year, when we hear that, okay, it has to work. There's something there if someone's pumping in 400 grand per year. But he was originally pitched on a small life insurance company, and he's got some background in the industry. He has experience. He knows what to look for. And he stopped the agent right there and said, there's no way I'm going to flow almost $3 million of my money through this small life insurance company you're proposing. He wanted one of the best mutual life insurance companies for his money. And I'll share which one he went with as we progress through this today. So what determines the best? because that is a question that can be heavily debated. What is the best company for you to go with respect to a high cash value life insurance policy? Well, there's two ways to determine what is the best. One, you can follow the money, meaning you can look at what are banks doing, what are corporations doing, what are the ultra wealthy doing, specifically with whole life insurance policies that are designed for high cash value. So for example, when I look at banks, we often hear that banks position a ton of money into bank-owned life insurance. There's truth to that. However, what companies do they select? Well, we're going to share an actual case study on that, but what I'll start with is back in 2016, might have been 2017, I was working with an individual out in California. He was interested in a whole life insurance policy for himself. However, he was an executive at a small bank, again, out in California. And we have a conversation. I brought up bank-owned life insurance, and he starts reading off the bank's BOLI holdings to me. He goes, we've got X amount with Mass Mutual, X amount with Northwestern Mutual, New York Life. He mentioned your 4 major mutual companies first, 3 of the 4 with that particular bank. There's a local bank we work with up here in Pennsylvania, where our office is located. The local bank we work with that we set up their bank-owned life insurance policies has purchased BOLI on 2 separate occasions. The first occasion, they opened policies with Mass Mutual and New York Life. The second time was Mass Mutual, New York Life, and Guardian. The first time was Mass and Guardian, I'm sorry. But my point is, in both occasions, it was Mass, Guardian, New York Life. There's 3 companies there that are among the top quality. So I can look at what are the people with the money doing. Can I follow them? When I look at corporations, small businesses do this as well. Often when we have a conversation with the CFO, Chief Financial Officer, they are looking at guaranteed rates. They want to know, what does the guaranteed cash value look like over time? And then also actual performance. And what I want to touch on with respect to actual performance is I am not talking about dividend history and what that has looked like over time, but what have policies actually produced? Meaning, if you take out a cash value life insurance policy, or before you do it, can you ask your agent the question or insurance company the question, hey, what has the cash value actually produced over the past 10, 20, 30 years with policies? The internal rate of return, not dividend history. That is always the question we want to ask. The same is true when we look at wealthy individuals. So those who are contributing 7 figures per year into cash value life insurance products, you'll often see them go to the major mutuals first. So your 4 major mutual companies are who? Mass Mutual, Guardian, New York Life, and Northwestern Mutual. We're going to touch on them in a lot more detail shortly. And then sometimes they will acquire what's called private placement insurance as well. That's a little bit of a different animal. It's a variable universal life insurance contract that allows you to participate in the stock market under the life insurance umbrella, keeping that cash value growth tax-free if you do everything properly. But private placement insurance is often exclusive to ultra high net worth individuals, usually $50 million net worth and above. No way I'm moving $3 million into a small company, that story I shared with you. So, first bullet point we touched on, follow the money. What are the big guys doing? What are banks and corporations doing? Can I copy them? That's an easy path to follow. The second thing, and this is my favorite, the data. So I'm a data-driven guy. I like to see the actual numbers. You ever hear the saying, people believe what they see, not always what they hear? You know, anytime I hear something about different life insurance companies, different strategies, loans, whatever it might be, my big thing is, okay, do you have proof of it that I can actually see? Because there's a million opinions out there from people in the life insurance industry. Maybe it's financial advisors that are anti-whole life, and there's always opinions that go back and forth. But do we have data that we can actually see? So if you're the consumer, this is the kind of stuff that I like to see. If I'm you, that I would want to see, or make sure an agent, your agent, is thoroughly examining this, because there's so much information out there. So data points. And this is also what these guys do that follow the money, banks, corporations, and the wealthy. Company size, that's one thing that is often considered. How large is the insurance company that I'm moving forward with? Are they a small to medium-sized company, or are they a massive-sized company? Financials, ratings. What does the financial health look like with the insurance carrier? So those are important. Years in business, this is good. How old is the insurance company? Have they gotten through the Great Depression? Did they get through 2008? How do they do with the recent coronavirus pandemic? What does their history look like? Those are all good things to look at. But here's the big data point underlined in blue. Proof of performance. And specifically what I mean here is not dividend history, because we can pull dividend history from most life insurance carriers out there, meaning what dividend rates do they pay to whole life insurance policies. Proof of performance means this. Did their life insurance policies actually produce strong cash values? Actual performance, not an illustration. This is so important in the life insurance industry. And in my opinion, just from individuals that I've worked with and have seen work with other agents over the years, this is the number one source of buyer's remorse. Specifically, what that number one source of buyer's remorse where people have regret with whole life insurance products is when they buy a policy, they're sold on the illustration, they see the cash value accumulation over time, and that cash value buildup projects an internal rate of return, call it a 5%. But then reality sets in. That policy under-delivers each year. 10, 15 years later, they measure the internal rate of return, what the performance looks like, and it's no longer on track to do 5%, it's on track to do 2%. That's where people look at it and says, you know what the heck was I just sold? This is not worth it at all. I'm getting out of this product. They do more research, they read bad reviews on whole life insurance. A way to summarize this is they were overpromised strong cash values and it under-delivered. So that's the number one source of buyer's remorse that I've seen with people who have opened whole life insurance policies. And then after those policies have lived the test of time and the products have under-delivered, that's where they say, man, if I would have known this, I would have not gone this direction. I would have done something else. So how do we avoid that is the question. Well, company selection plays a big role. So here's what we're going to touch on here. Quite a bit of info. What we will begin with is 4 major mutual companies. If you follow the money, going back to the banks, corporations, wealthy individuals, these are their first choice when it comes to whole life insurance products designed for maximum cash value. These companies, in no particular order here, Mass Mutual, Guardian, New York Life, and Northwestern Mutual. Quick side note, if you're an agent, you know this. If you're not in the business, you may or may not know this. Northwestern Mutual is a company that our company, IBC Global, cannot sell. It's a company that any independent broker cannot sell. Northwestern Mutual offers whole life insurance products, but you can only acquire those policies through what is called a career agent. Someone who works for Northwestern Mutual and will likely sell them as the first option in most cases. So over the years, I've been questioned a number of times to say, hey, why do you even talk about Northwestern Mutual? Because you can't sell them, Steve. Well, I was talking to someone, I really liked them about 2 weeks ago. I said, they've delivered. Like, if you look at teams that have won 5 Super Bowls or more, if we're going to use an NFL relation here, we've got 4 teams, right? By coincidence. We have the Steelers, they won 6 Super Bowls, the New England Patriots, San Francisco 49ers, and then the Dallas Cowboys. Whether you like or dislike any of those teams, you can't argue that they have run their organizations poorly. Maybe they haven't run them well recently, but they have Super Bowl wins. Just like if we take different quarterbacks, Tom Brady is considered one of the greatest quarterbacks of all time, right? 7 Super Bowl wins. So whether we like the company or not, or whether I can sell them or not, I can't not put them in that mix because they have a track record of always delivering strong cash values. So that's the main reason we mention them. They are a quality company, just like the other 3. So to progress on here, some information. 2022 dividend interest rates. Mass Mutual at 6%. Guardian at 5.65%, New York Life at 5.80%, and Northwestern Mutual at 5% flat. Here's what I'll mention with this, is if you're interested in a whole life insurance product specifically designed for maximum cash value, often what happens is, let me ask this, where did your eyeballs go first? Which company has to pay or has to look the best with respect to the cash value growth right now? Mass, because I've got the highest dividend interest rate. If I were to rewind the clock about 12 to 15 years, Mass Mutual would not be on the top. Here's what I'll mention, is whenever we are selecting a life insurance carrier, I would not select a company based on who is paying the highest dividend rate or who looks the best on paper via an illustration today. Because one thing that has been true, when we look at the actual performance, the net internal rate of return, the net growth rate, all four of these guys have gone back and forth with each other. Literally, I would be comfortable with my money, closing my eyes, picking one of them out of a hat if I was going to pay the same dollar amount and treat any of those products in an identical fashion. So my point there is all top tier quality and dividend rates. Granted, we do have a 1% spread from top to bottom. They all go back and forth with each other with respect to actual performance. And one side note too, a dividend rate, if I have a 6% dividend rate, let's assume you've got $100,000 in cash value. What's 6% of $100,000? $6,000. If you have a policy that has a 6% dividend rate and you had $100,000 in cash value, you would not see it grow by 6%. So we won't get into details on this. Maybe during the the Q&A section at the end of the webinar, is a dividend rate is always a gross rate that is credited after the company's insurance expenses, mortality charges. What I want to look at when it's my money, like where my eyes are going with my policy, is the net internal rate of return. That provides transparency with respect to how much did I pay in and how much did it grow by? What was credited in the guaranteed rate and dividends to my policy? So we've got the 2022 dividend rates, financial ratings, and we've got the Comdex score up here. We see Mass Mutual at a 98, Guardian at a 99, and then New York Life and Northwestern Mutual at 100. So what this Comdex ranking indicates here is it is really a grade of, call it, financial health. So we've got a lot of life insurance companies up here. And here we go. So when we look at this guy, so we've got company and ratings on the left. What do we see here? Different rating agencies. You've got the AM Best, Standard & Poor's, Moody's, Fitch, Weiss. Most are financial strength, and then we've got safety rating as well. And then the Comdex ranking really gives you a grade, call it a percentile, of everything grouped together. A++, 1 means I have the strongest rating possible with that particular rating agency. So this kind of stuff is good to look at. I don't spend too much time going into financial ratings. However, you will notice with the top carriers that have always delivered the strongest internal rates of return on cash value tend to have among the strongest ratings, which is always a good thing as well. It's an indication of their financial health. So let's take a look at this. If we just look at the big four here, what do we notice? Comdex, Mass Mutual, 98. Guardian, here reads 98. However, this is an independent analysis that was last updated in 2020. The 2021 results have not come through yet. So Guardian's independent literature confirms that they're now at a 99. Not that there's a big difference there, 98 to a 99, but I did say 99 before, and it is at a 99. This is just not updated yet. This report, we ran it today, but the agency has just not updated everything yet. So this is a full, what is called a vital signs report, where we had actually run this on a number of companies, but that's just a quick overview on the Comdex score. So cream of the crop there with respect to ratings and such. Now, what I want to touch on real quick here as well is top level commission rates. So we can address this more in the Q&A section as well, but when it comes to commissions, specifically on first year base premium dollars, all of these companies offer life insurance in the state of New York. without getting into detail on this, and we can again during the Q&A, if a company solicits life insurance in the state of New York, what that means is they have to abide by New York state laws with respect to commission rates in all states nationwide. So some insurance carriers elect not even to offer life insurance in the state of New York because New York has a lot of regulations, one on commissions and a lot of other areas as well. But my point here is you will see a company typically cap out at about a 95% commission rate of the base premium. So we'll touch on policy design a little bit, but if I have a policy where I have a $10,000 base premium, and then I've got, say, $90,000 going toward PUAs, but focusing on that base premium, which typically does not show up in cash value in the first year, the highest I'll ever see that on traditional life insurance products is 95%. And not all companies even go that high. So we'll have future webinars where we just really dig into compensation with different companies and products, but this just gives you a glimpse of what things look like. Quick side note is if you're working or looking at a company that does not solicit business in the state of New York, the commission rate typically will max out between 130 and 140% of base premium, which is a big, big difference when you look at it. And why we see these ranges here too, looking at the MassMutual example, 18% to 95%, that depends on the insurance product. So I know this is a little vague here, and again, we'll have future webinars where we really dig into commission, going through certain different products and such. Because a question that comes up is, how do commissions impact policy performance? Years in business. So looking at the four major mutual companies, what do I have here? MassMutual has been around for about 170 years. Next, we've got Guardian at just about 162. New York Life, they're the oldest, 176, and then Northwestern at 165 years. It's a long time to be in business, and they've just kept on growing over the years. And then here's the big thing, proof of performance. So we're going to look at some actual numbers on this point, but when we look at proof of performance, I've got 4 to 6% here, and this is talking about history. What did we start with when I mentioned those core benefits, the 3 core benefits to a cash value life insurance policy? What's the first one? Safe area to position your money. And the net internal rate of return should fall where? Typically anywhere between 3 to 5%. Here we've got 4 to 6%. Why the difference? This is more so based on history. The first policy we'll go through actually had an internal rate of return north of 7%, which is sweet. However, a big, big difference between policies that have lived the test of time and today is interest rates are much different. They're much lower today, and so are dividend rates. So why I like to state 3 to 5% today, if you're considering a whole life insurance policy or already have one, is just to properly set expectations. Could it do better? Sure. Will it do 4 to 6%? I'm not confident saying that. And just with human nature and setting expectations, if I tell you your money will do close to 6% and it does closer to 4%, you don't like me that much. If I say 3% and it does 4% or it does 5%, everything's great. So setting expectations is always important, and rather than overpromise and underdeliver, much prefer the opposite. So we looked at, some financial ratings there with respect to the Comdex score. What we're going to look at next is some historical performance. So these are a number of studies that took quite some time to put together. We'll look at policies issued in the 1970s, one from 1975 with Guardian, one issued in 1980 with MassMutual, then some issued in the 90s, 2000, and we'll look at some more recent policies as well. So this piece will be very, very valuable because it will give you a glimpse into what policies have actually done, not just illustrations. So let's get into it and have some fun. What we'll begin with here is this guy. So this was from Guardian. I got this back in 2012 to 2013 when I actually worked at the Guardian agency. So that's sloppy handwriting. It reads real life contract from Guardian, policy from 1975 to 2005 was the study period. This was on a 35-year-old male. Best Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.